Hello, my friend. Welcome to Charley Retail Invest. Let's follow the latest trend in US economy and share our recent investment in stock and bond markets. After the latest FOMC meeting on Wednesday, September 18, the Federal Reserve Chair, Jerome Powell, announced Fed's plan to cut benchmark interest rate by 0.5%, thus making the current interest rate level from 5.5% to 5%. The Fed's decision to cut by 2 basis points was rather surprising, as the market initially expected the Fed to start cutting by only 1 basis point, which is 0.25%. The fact that the Fed's cutting larger than expected demonstrates the central bank's concern over the job market in the US. This is because if the interest rate is kept at a high level for a longer period of time, then companies across the country would find it very expensive to borrow money from banks or investors in order to operate as usual. Consequently, companies have to lay off more and more people to reduce costs and save capital. Therefore, unemployment rate will skyrocket in the next 6 to 12 months. So we can see that the focus of Federal Reserve has shifted from fighting against inflation for the past 2 years to stabilize the price of goods and services, to stimulating the economy and ensure unemployment rate do not go even higher from the current level. Right now, the market has responded quite positively to Fed's initial cut of 0.5% of the benchmark interest rate. The major US stock market indexes did rise significantly in the coming few days, following the Fed's decision to cut interest rate on September 18. We can see that S&P 500 index has reached a new all-time high on September 19, which broke the previous record set on mid-July of this year. However, as we mentioned before, the Fed's decision to start cutting interest rate by 0.5% has indicated the US economy is heading into recession in the near future. Otherwise, there's definitely no need for the central bank to cut interest rate this dramatically and risk inflation coming back sooner than expected. As retail investors, if we invest our money heavily into the stock market right now, with the prices of stocks near all-time highs, we may risk losing a large chunk of our investment in 2025, when the economy really hits into the recession territory. If we look back in history, we can see the previous interest rate cut cycle had matched perfectly well with the recession period. This graph shows the benchmark interest rate from 2000 to 2024, and the 3 shading areas are when the US economy is in recession. So back in 2001 and 2007, we were facing very similar challenges as today. In both cases, the benchmark interest rate had been kept for over 5% for more than 2 years. And when the Federal Reserve started to cut interest rate, the economy went into recession about 6 to 12 months afterwards. To make things even trickier, the Fed initially cut interest rate by 0.5% both in 2001 and 2007, which was exactly what happened on September 18 of this year, 2024. If we look at the S&P 500 index performance in 2001 and 2007 periods, we find that the S&P 500 dropped by a whopping 40% from 2001 to 2003, and dropped 52% from 2008 to 2009. So we need to be extremely careful when buying heavily into stock market right now, because chances are stock market crash may happen in 2025, just like what happened in the previous 2 cycles. Of course, many institutional investors and Wall Street analysts think that this time is different, as Federal Reserve can start money printing and quantitative easing to stimulate the stock market and save the economy. This may well happen in the future. However, before that happens, we need to see the stock market crash significantly and unemployment rate goes above 7%. And then the Fed would have the rationale and support from the public to start money printing and QE. Right now, we are in the calm before the storm. CNBC recently reported that layoffs soared in August of this year, hitting their highest total number for the month in 15 years, while year-to-date hiring rate has the lowest in 19 years. The report also showed that the biggest growth in layoffs came in the tech sector, with companies announcing over 41,000 job cuts, the most in 20 months. A recent layoff example is Cisco, and it announced last week that an additional 563 jobs at its San Jose headquarters will be cut in order to save operational costs. Just a month ago, Cisco had already announced a plan to lay off 7% of its global workforce, concentrating on faster-growing tech fields, including AI and cybersecurity. Another news release comes from IBM, who had been doing silent layoffs for the past few quarters. Thousands of employees, mainly senior-level software engineers, sales, and supporting staff, were impacted by the most recent layoff in IBM. Moreover, those individuals would have to sign an NDA or non-disclosure agreement and not talk about any specifics of the layoff before they could receive the severance package. IBM reportedly took $400 million to cover the cost of the planned layoffs in the first quarter of 2024 and had paid more than $300 million in 2023 to pay for the severance packages, during which 3,900 jobs were cut. However, the company didn't share the exact number of workers being affected by the layoffs. As a matter of fact, silent layoff is not unique to IBM, but has been widespread in different industries. Instead of doing large-scale layoffs that often lead to news reports, companies nowadays would cut staff at different stages of a fiscal year and would cut by a smaller scale in different business units. That will lead to many silent layoffs not being reported or noticed by the general public. So the real number of people being impacted by the layoff waves is actually much larger than reported in the news. Of course, other sectors are experiencing the same thing as the tech sector. Forbes reported on September 12th that Goldman Sachs is expected to let go 3% to 4% of the bank's global employees, which amounts to roughly 1,300 to 1,800 positions. Goldman Sachs has an annual performance review process that typically results in workforce reductions ranging from 2% to 7%. Employees constantly go through the pressure of not meeting the high bar and are under the risk of being let go in a few months, which is very demanding and tiring compared to government jobs that would never have such a risk. All these workforce reductions will incur unemployment rates to spike quickly. At the same time, most people have to cut unnecessary spending in order to save money for a living, especially when people lose their jobs. So we will have to cancel planned vacation trips to Florida or Hawaii, spend less on dining in restaurants, and cook more at home, and do not buy the new iPhone model that comes out every year. All this cut in consumer spending will make the earnings of companies collapse, which will lead to huge downward pressure on the stock prices in the future. In the meantime, credit card delinquency rate and mortgage delinquency rate will continue to rise as more people lose their jobs, which ultimately will create a disaster to the financial system and may even cause the banking and real estate industry to crash. That, my friend, is the ultimate reason that the Fed rushed to cut interest rate last week. Another leading indicator to recession is the inverted yield curve, which is the 10-year Treasury bond yield minus 2-year Treasury yield curve. When the difference between long and short-term yields raise above zero and keeps climbing, that indicates the economy will hit recession in 6 to 12 months. As we can see, the inverted yield curve has been uninverted around September 5th, and the long and short-term bond yield difference has become positive again after it dropped below zero in July 2022. That means the clock has been ticking starting on September of 2024, and we shall see clear signs of recession by Q2 or Q3 of 2025. If we look at the history of inverted yield curve back in 50 years, we can see that whenever the yield curve uninverts, Recession comes after that within a year. I see no difference this time. This chart shows the year-to-date price change of Nasdaq 100 Index ETF, QQQ. It's clear QQQ's price has been fluctuating up and down for 2.5 months since it reached its all-time high in mid-July. So we are essentially entering a new regime where stock market index is not increasing consistently like it did back in 2023 and early 2024. Instead, the market will go up for a few days and go down for a few days and repeat this up and down pattern. However, it's much harder to make a lot of money in the current situation, as we cannot keep buying into stocks and just hold them and wait for them to reach new all-time highs like we do in a bull market. Of course, we are still quite far away from a stock market crash, or at least it would not happen in 2024. I think the market will keep its fluctuation pattern until US presidential election is completed in November of this year. And I will keep doing small short-term trades on stocks to seek for quick capital gains using small amounts of money. However, as we enter 2025, things may be very different, and we will see a big crash on the stock market. At that time, short-term trades will not work either. And if we invest in stocks then, we may see our investment go underwater very quickly. The best way to invest in a bear market is to cash out most of our stock holdings and preserve value in bonds, gold, or cash. And we will wait until the Fed comes in to save the economy by astronomical money printing and quantitative easing. After that happens, we will be able to invest heavily into stock market indexes at a much cheaper price level. This is CRI investment portfolio as of September 23, 2024. Compared to last week, we sold all of our Tesla stocks on September 19, one day after the Fed announced its rate cut plan. As detailed in our video on September 5th, we purchased 33 shares of Tesla stocks at $211 per share on August 30 and held them for 3 weeks before selling them at $241 per share on September 19. Through the process, we secured a short-term capital gain of over 14% and made a profit of $997, which is quite good. And we are not actually bearish on Tesla stocks, but the main rationale to cash in right now is to avoid further turbulence of Tesla's stock price over the next few months. In the future, if Tesla stock price drops to a lower level again, we would consider buying into it and looking for new opportunities to profit. I'll be sure to keep you informed if that happens. Another big trade that we did over the past few days was that we purchased 230 shares of TMF, which is 3 times leveraged to long Treasury bond ETF TLT at a price of $59.8 per share. Now, TMF's position is over 55% of our entire investment portfolio. In the meantime, we also bought a small portion of UBT, which is 2 times leveraged to TLT, and UBT's position is 1.7% of our portfolio. We can see the 30-year Treasury bond yield has increased from 3.9% to 4.1% after the Fed's interest rate cut on September 18. This led to tanking of prices for long-term bonds, TLT and TMF during the past week. And we are bullish on the future performance of TLT and TMF, so we continue to buy more long bonds as the bond price comes lower. The reason behind that is we think 30-year Treasury yield has the potential to go lower from 4% right now to 3% in the coming months. If that happens, TLT price will go up by 15% from the current level. And the ultimate factor to impact bond yield is the inflation rate in the economy. This figure shows the inflation rate change from September of 2023 to August 2024. As the Fed keeps interest rate above 5% and continues its quantitative tightening measures, inflation rate has come down from 3.7% in 2023 to 2.5% in 2024. As the labor market continues to cool down and unemployment rate continues to go up, we anticipate inflation to go down from 2.5% now to near 2% in mid-2025. By then, the long-term Treasury yield is likely to go down to 3%, or lower. Therefore, we will continue to hold our position in long-term bonds, TLT, TMF, and UBT. At the same time, we will keep an eye on the economy and the Federal Reserve's policy change. We will let you know firsthand when we need to change our investment positions in the future. And that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charley Retail Invest. You're also more than welcome to leave your thoughts on the stock market in the comment section below. Thank you so much for your time and support, and I will see you in the next video. Please take care.